Let's wake up.
We'll start, I guess. Looks like everybody's here that's going to be here.
Crystal can't come.
She will not be here. Mike will be filling in for us and the notes.
Nina won't be here either. There's something tonight that came up.
So, Frank, if you have reports for us?
Oh, yes,
or
indeed.
Review the reports?
Okay, yeah, I think we can do that. I have to confess to some misunderstanding myself. But anyhow, let's take a look.
We're all in the dark.
First of all, we still own the same stocks that we owned last month. Basically, 205 shares of Aflac, 110 shares of Cognizant, and 22 shares of Google. And Google was up over 600 here for a while. It may still be.
What did we pay for it when you got it?
Oh, we paid the
$2.98.
Yeah, that was
really good.
Yeah, that was back in
7
05.
years ago, yeah.
05, yeah. I'm the guy that sold my own out at about 380 or something. I thought, man, I've got to make a profit on this, and now I'm kicking myself. But hey, that's another story. Anyway, so I'd like to see us eventually begin to diversify some more, which we will as the year goes on, and maybe it require us to sell some of this and use it to buy other stocks, to kind of even out our portfolio. Because the other one I was kind of interested in was Netflix. I'm still leery of it, and I haven't bought any myself, but it sure looks good on paper. But we're already pretty heavy with the Cognizant and the Google into the whole technical area.
I like this other company you gave us.
Yeah, well, we may look at that tonight then and make a decision. Anyhow, we'll have those stocks. That's about 94% of our portfolio as of the 11th, which was last weekend when I did this. The broker, we've got $1,808.03 in the brokerage account, and in our bank account we have $183.39. Okay, for a total cash of about $19.91. And so we've got some money there to buy something, plus whatever we take in tonight if we make a decision to buy.
What is suspense?
Pardon?
What is suspense?
You know, it's something that we really don't use. It's money that's held. If somebody's leaving the club and we're putting money aside to pay them out, you have a suspense account. You can add that. You suspend it. So,
And then it's called a suspense account.
yeah. When you suspend it, you can't spend it.
Yeah.
Exactly.
I need one of those.
Yeah, so I've never seen us use that in this club, to tell you the truth. And I'm not sure what the WD liability account is either. But the software prints this out. I'm not as familiar with the software as I'd like to be eventually, but
WD.
yeah. Anyway, so our total portfolio value, it says, is $11,544, and I don't know where they get that number from. Oh, that's the total cost plus the money that we've got. Okay, but market value is what I'm more concerned with. We're really worth $32,900 and about $38. Okay, at this point in time. Did you by any chance bring that old report, Kevin?
I did. I'm sorry.
Oh, that's okay. Kevin sent me a copy of this from back in, I don't know when it was, 1980 something or 90 something. And anyway, the value at that time was over $350,000.
No, it was over $500,000.
It was like 600,000.
Oh, was it? Okay.
Microsoft was probably in there, I bet, was it?
We had
It was
But
late.
they
It was
had like
late
22
'90s.
members, and they had a ton of money in this, And most of those folks have now gone on.
We were going
to
to take a cruise.
Just rewards. Yeah.
We should have.
Well, as long as you don't take that and over the off the coast of Italy.
Oh yeah.
It's Italian cruise.
The Italian cruise, yeah. Anyhow, so that's the current status of our value. They call this a valuation statement. It just gives you the value of the club at the time. Then your individual member status is over here as well. It shows each member what you've paid in since January 1st. I usually go back a month, and so you just see what you've paid in since the first of the year, or the next one, for example, will be since February 1st, and so on, because that's whatever we pay in tonight will be recorded. Shows the total amount that you've paid in. The negative figure for Lauren is because he's actually taking out more than he's put in, so he's in a negative area now. Total paid in plus earnings, number of units purchased since January 1st, total number of units, market value, and your percentage of ownership in the club.
Frank, did you ever figure out what that subtraction of shares
I didn't.
was?
I was going to bring that up, yeah. I didn't. It took an equal amount from everybody, so it had to be something to do with, I'm assuming, and again, I'm not as familiar with the software as I could be down the road, I suppose, but I'm assuming that it's because of those members we were buying out that it actually reduced shares in some way in the group and just took it equally from everybody. You still have the same value. I mean, nobody's been disadvantaged that I know of. One of the things I'm still looking at, Mike, and I did print off, by the way, the member status report description. I thought I'd spend a minute and go over that tonight with you as well.
You're a big liar.
Larry, come in. Greetings. Because, you know, some of the things that got me going, Mike, for example, you've contributed a total of $250 at this point. Total paid in plus earnings is now $219 for a net loss of $41. I think that has to do with stock prices.
Where do you
may
see
have
the
come down.
219 at?
Over here.
Under total paid in plus earnings.
Oh, I see.
See that? Yeah.
Okay.
And I'm not sure what it's doing. I know that it's okay. They've been using this software for years, and clubs all
I
over the
trust
world
you,
use
Frank.
it. But I don't know what's happening with
Just
that.
wondering what it was.
So we've lost money.
Well, some of us.
Well, no.
Some it depends on when you came
Individually,
into the
yeah.
club.
Yeah.
If you
Tom
came in
and
and
I-
the stocks have gone up since then you made money. Where Mike
Tom
might
and
have
I
come
agree.
in and he was in some months before the end of last year, and
Yeah.
we had to sell a lot of stuff to pay off people, and so we may have had to sell some things at a loss. I don't know what all happened. Who's that at the door?
I don't know.
Do you mind if I listen in? Or is it a private?
You got $20?
Oh, it's a paid.
No. Come in.
I just heard you say something about investing, and I thought, oh, I need to know more.
Oh, well, okay, yeah,
Just listen.
you're welcome to. We are an investment club, and at some point, if you decide you'd like to join one, you might come see us. We meet the third Wednesday of each month, 7 o'clock right here.
Okay,
So.
I'll make note of that. Third Wednesday.
Anyhow, the member status report, which many of you probably have a copy of right now, I went ahead and printed off what information I could get about what each of those columns are. Of course, the name is the member's name, listed in alphabetical order by last name. Only members who own units on the report date appear in the list. So if you didn't have any units at all, you would not appear on that list at all. Paid in since month, day, and year is the amount paid in by the member. They dropped the word by here. Since the date specified in the Show Members Contribution Since box. This column does not include amounts paid on the displayed date. So anything you paid tonight won't show up until next month. Okay. The total paid in are your total payments and fees less any withdrawals from the date of the first payment or fee to the report date. Any beginning balance investment is included. If a member withdraws more than the amount they paid into the club, the amount in this column will be negative, which is where Lauren falls. Okay. Total paid in plus earnings. The total paid in to date plus distributions of earnings. Any beginning balance investment is included. This figure is the member's tax paid basis in the club. If a member withdraws more than his tax basis, this value again may be negative or zero. Okay. And I'm passing this around, and you can keep it if you want, or I can print off copies and send them to everybody, whatever you'd like to do. It just kind of explains each of these columns. The units since month, day, year. I was doing this because I was trying to figure out why Mike's question, how come our value or units dropped. The number of units purchased since the date specified in the Show Member Contribution Since box, which is a box I fill in as I print these reports. This column does not include amounts paid on the displayed date. Units may be something if the member has withdrawn. I'm sure they meant to say maybe negative. Whoever wrote the book didn't get it all in there. Maybe negative if the member has withdrawn more than his payments. Total units is the total number of units owned by the member as of the report date, which would have been last Sunday or Saturday whenever I worked this out. Market value is the value of the units covered on that report date. Club accounting. Pardon?
Oh, I was talking.
Okay. Club accounting online uses the most recent securities valuation date to determine the value of each unit. Each month when I produce these reports, the first thing I do is I run what's called a valuation statement, which basically goes out on the internet, looks up all the current prices of the stock as of that date, and then that's how it calculates the rest of this stuff. And so if I ran that valuation, let's say on a Thursday, and then I did this report on Saturday, you would really be looking at Thursday's numbers. So that's why I try to run it the same day I do the report, and then it all balances out. Let's see, market value, got that. Percentage of ownership is your percentage in the club. What percent of the club you own, for example, the club total is 100%, so right now Mike, for example, owns 0.53% of the club. with his investment, okay. Our high roller is Lauren at 22%. No, I apologize. Our
Kevin.
high roller is Kevin, yes, at almost 35%. These are the two that, based on our club agreement when we put that together, need to basically not make any contributions and or withdraw some cash either way.
You guys need to make more contributions.
Or, yeah, you can make, now they could withdraw cash and divvy it up among us, and then we could contribute. That would balance it out. Make it work. But anyhow, so we need to get everybody to 20%. I think I'm under, but just getting closer. I was like 16%, yeah, 17%.
Yeah.
So, and anyway, and Larry, you're over too, so. Wherever Larry went, there he is. Now,
Down here.
He's
I
headed.
guess I don't want to make out a check then, huh?
Yeah, some of you
No,
are
you
in that
can't.
1% and the rest of us aren't.
Yeah. Yeah, Larry, you probably shouldn't make any contribution. Like I said, unless you want to withdraw some cash and then contribute to bring it back up, but that wouldn't make a lot of sense, would it?
Not a lot.
Yeah. So what you can do is you can take whatever we come up with as a buy tonight, and then you can use your money and just go buy it in your own account. Not that we're trying to discourage you, mind.
Well, that's all right.
Yeah.
We'll catch up eventually.
Yeah, we'll catch up
Yeah.
We'll
eventually.
start to catch up a little bit here.
The other option, of course, is taking your wife out to dinner at a fancy restaurant using that money that,
Yeah.
think of that as an investment.
Valentine's is over. Forget about that.
Forget about the wives.
That's
Wow.
right. Wait till next year.
I don't have to do anything for her birthday.
Now, the column I didn't include, but we'll start including that next month, is they have they have another column you can add called the CAR, which is your compound annual return since a certain date. Okay. If you go back to the date that the club started, they call that a CAR number. Of course, that's going to look really good. What I usually do is I go back 1 year. I'll pick up the valuation statement that's closest to the same date a year ago. And that way you see what you've done within the past year. Now, for some of you, you haven't even been here for a year, so it'll show up the same anyhow. But if you've been here over a year, like, for example, Lauren might have made 25% on his money in the early years, and maybe last year he lost 15% because the stock market was down, type of thing. But it gives us it's kind of like, what have you done for me lately when you look at your performance? Okay, so anyway, you're welcome to read through that if you'd like or whatever, but I just thought, but I still don't have an answer to Mike's question. Any questions on either of the reports? Okay, now, as you are aware, tomorrow, well, you may not be aware, tomorrow Mike and I are going to go to lunch over at Sizzler's.
Oh,
We'll
yeah.
pay for that ourselves. That's not club money.
What?
Okay?
You didn't say that before.
And then we're going down to Magic Valley Bank, and I'm going to get him a signature card in Magic Valley Bank, so he and I will both have access to that account. I'm also going to share with him our unit password and name and all for the TD Ameritrade account. And there was a third thing, and I forgot what it was. It just came to me last night. Where else do we keep them? Oh, the iClub account.
Yeah,
I'm going to put you in as same as me, where you can make any changes you want to in there. That way, if I die or something, we got somebody that can continue to take over the club.
And he's young.
And
That's a hard decision.
You could have gone all day without saying that.
You buying that tricycle you're riding around?
yeah. Well, I almost got it out the other day. It was nice. And then today it's all snowing.
Yeah, we got a vested interest in you not
Yeah.
riding.
Oh, okay. Anyhow, that's the report, such as it is.
Great. Good job.
And if I can have a copy of, well, I can print one too, but if I can take this, the bank wants to know, they said they needed a agenda or a meeting minutes that indicated
That it was
that,
approved.
that Mike has been approved by the club to be a signer on the account. So I said, okay, we'll fix something up, so we did.
And that's it.
Okay. Here, Kevin, I'll leave that with you.
Okay, so with that, the next item for new business is work on the stock selection guide.
Yes, okay.
That's you.
That's me. Oh, it is me. Okay. Lauren, I was going to ask you, LKQ, you're going to invest in that one?
I don't know.
That's on my watch list. And
What
it's
is it?
looking
Can you
pretty
give us a
good.
little rundown of what it is?
It's just
LKQ?
LKQX, I think it is.
LKQX is the
QX.
symbol.
Corporate.
They sell used auto parts and acquire wrecking yards and stuff.
Oh.
Yeah.
They're at
And they-
3180. today.
What is it?
No, it should be higher than that, isn't it? Oh, maybe not.
31.
I'm watching
38.
Copart too.
Yeah.
I'll tell you what, I'm doing good on Vistaprint, I'll tell you that.
Yeah, I'm holding on.
What's it called again?
VPRT.
VPRT, Vistaprint, we bought that last year.
And what is it?
It's a company that, not to interrupt you, Lauren, I'm sorry.
No, go ahead.
They, you want business cards, you have a small business, you want forms printed, things like that, they do all
Bought
that
it
for
at
you.
26.
Very inexpensive.
Listen to you.
And they, I don't know, they've got like 50,000 accounts around the world or something like
They
that.
give you 250 free.
Yeah, they do, that's
advertised
right.
online.
Yeah.
We should have bought it.
So
Well,
what is it
perhaps.
now?
39.
39.
39, but when we were looking at it, it was what, 80 or 90 or something?
It was kind of quirky because Frank brought it up and I was watching it and it dropped and then I bought. It dropped
Yeah.
like 15
Yeah.
point.
And I bought 200 shares at the higher price, and then when it dropped, I bought 200 at the lower price, so that kind of lowers your overall investment.
Yeah, a year ago it was at 50, around
Is
56.
it still a buy?
We have
A
to look at it.
recommended buy?
Have to run an
SSG.
SSG and find out.
Yeah.
This is a good assignment for you.
But it was odd because this outfit that I joined, this IAS, the Investors Advisory Service, they came out and advised, said, hey, this is a great stock. And so I went out and I bought my 200 shares, and the very next month they came out with an alert that said, we're dropping it off our list. The company was having some issues with, I've forgotten what it was now, but I thought this is only a temporary downturn. They're crazy to drop it off their list, so I went ahead and held on to my 200 shares and then added a couple more.
If we'd have got Vistaprint, or not Vistaprint,
They'll make business cards.
Netflix, yeah.
And that's the company, and they have.
They're really, they work with small businesses that don't have big budgets for lots of forms and things.
In the last 3 years, it would be nice if we could throw this up on the chart or up on the screen. The last 3 years, they went as high as like 62, then they dropped down again down to 20s, and they went back up to 56, and again they dropped back down.
So we're catching them on the downturn.
That's
So we'll
right.
go back
Right.
up.
We know to sell around
Put it up on the
60.
screen if you want. I mean, I can.
Ah,
You're just internet connected, aren't you?
Yeah.
Yeah, I can connect here. Which I'll need to do anyway, I guess, if we're going to take a look at EHR. Or Danisher. Oh, hey, somebody left me a, that's nice of
A
them.
little jump drive.
Well, hey, I'll turn it in at the desk.
Yeah, they'll come back for it, I'm sure.
God, that is so.
Yeah. That's a homework.
People lose all their stuff.
Let's see, gotta find the right holes first of all. Don't forget to log off.
For such a small room, there sure is a lot of stuff in here.
There
Too
is.
much. It's too much.
Oh, too much art, you mean?
Too much.
Kevin, where do you look at it? I always go to Google Finance. Were you looking somewhere else?
I just went to MSNBC, but that's fine, Google Finance.
Okay.
Somebody gives you a chart.
Slash point. Yeah, let's see. We're looking at Vistaprint.
Yeah.
Okay, yeah, they're $39 today. Hey, I'm getting ahead on the stuff I bought on the low end. Okay, yeah, let's see. Let's look at the last year.
More to the
I
right.
brought up a 3-year one, but
Oh, okay.
You brought, can you do it?
yeah,
I
3
do
years right
5
next to
years.
That's 5 years.
Okay.
see the
Yeah, they've been as high as the 60s and now
It
they're
is
down.
pretty volatile.
yeah, it is.
Yeah, kind of up and down. But then the market, 2010, of course, everybody was down. That was the kind of crazy year.
Boy, it
Well,
did
we're
drop
gonna
like
look
a
at
rock.
this. If you're interested, we can have Lauren do an SSG and bring it in
Maybe.
next time, if you'd like.
What'd you buy it at?
26.
Yeah.
Well, you did. Wow.
You did pretty
Yeah.
well.
I got 200 shares at 26 and the other 200 are in the 40s somewhere, so. I'm probably about net even when you look at it. But if it goes up to $60 a share again, I'll be happy.
I think it will.
Yeah. Just might, okay. Anyway, so yeah, if you'd like, we can have Lauren or somebody else, if you want to do a SSG next time and bring it in and we'll study it and see if we want to put some money in it.
That'd be a good assignment for somebody.
Would you like to try SSG together? Would you mind coaching some of us to do that at least one time? Sometime we
I'll
could
do
meet
something better
individual?
than that. I'll show you. Yeah, I can do that too, but I'll show you tonight. There's some places you can go to learn how to do SSGs. More than just for me, because I'm not.
We like human beings.
We do. We learn.
Frank.
Like
So get this false reputation as being really good at this, and when you guys all lose money at the end of the year, you got to be hunting for that.
No, we want to just learn.
Okay.
But we want to make quite a profit too.
Okay. Well, let's take a look at Danaher. Give me just a second here to bring it
That's
up.
what I did the report on.
Let's see.
Oh, you did it. You did it, huh?
PK back
That's
up.
pretty good.
Okay, how to do this in some chronological order.
So are you going to buy some?
No, not personally. I won't. They like
the
buy
club
it,
might.
they buy other companies and like apply their it's like Danaher process to it, and make them profitable.
Like being
Yeah.
little.
It is kind of like that. Yeah.
Vulture
Like
capitalists.
That's
Vultures.
a different kind of company I think for us to have. Too.
Yeah,
like
that would be. The reason I kind
They don't make
of, but
any
not only
money
did
on
IAS say it was a good
Like a fat.
company they thought, but I thought we need to branch out.
These guys
from
are a lot of fun, and
technology.
they're willing to
Pretty
buy
much
it.
technology.
What's the matter?
Yes.
No safeguards whatsoever.
Mine.
Okay, first of all, here is value line, and you may have looked at this, may not have, for Danaher. Okay, and they rate them at 3, 2, and 4. Are you familiar with those numbers or what they mean?
No.
No.
Timeliness is probably the key number. They have 1,700 stocks in the standard edition of Value Line that they rate, okay? And they rate the top 100 as a number 1, the ones that they think are really going to do well in the next year. Now, keep in mind the words the next year, because we tend to look at stocks over a 5-year period. We're not so, I don't care if it's going up or down this year, as long as 5 years from now it's going to be up where I think it ought to be. Okay, so the top 100 get a 5, I'm sorry, a 1. The lowest 100 get a 5. The next 200 coming down from the top get a 2, and the next 200 coming up from the bottom get a 4. And then the middle range, the 900 stocks in the middle all get 3s. So 3 is kind of average as far as they're concerned. So they're saying that Danaher over the next year is probably going to be pretty average. The safety has to do with basically the size of the company and the chance you have of losing money, because they go bankrupt or something like that. So at 2, they're saying Danaher is a pretty solid company, a lot of funds, and you're pretty safe with this one. Okay. Now, technical is something they added a few years ago, and what it does is it tells you what they think it's going to do in the next 6 months. So what this tells me, and we'll read about it down below, is that they think Danaher in the next 6 months isn't going to be so hot. In fact, this whole year, they don't think they're going to do great. But in the coming years, they think long-term it's going to be a pretty good investment.
I'm not sure I've ever seen a value line with 111.
I haven't either, but we could probably do a search for them.
I wonder about that.
Yeah. Apple might be pretty close to that right now. Okay. A lot of this stuff I won't go through here, but we can sometimes spend some more time on Value Line if you want. Another thing I like about Danaher is notice they had a 2-for-1 split here back in about 2004, and they had a 2-for-1 split back in 2010. I like companies to split.
Yeah.
Because what they do is if you own 100 shares of stock, suddenly you have 200 shares. Now, they're all worth half of what they were worth before.
Same price.
Same amount of money, okay? There's no net gain. However, history shows us that invariably the stock price starts going back up again. So you come out a winner because you got twice as many shares and the price starts rising again. The reason they split quite often is that their price is getting too high. People in the market aren't really buying the stock. Oh, I'm not going to spend $500 for a stock. And so they've split it so that, $250, this is a bargain, and they'll buy the stock, even though technically it's worth the same as it was before. The company's no more valuable than it was. Okay, all the numbers down here is what we used to use to fill in an SSG. Now we do it all off computer and let it do the numbers for us. Okay. Down here it tells you what the business is all about. It says Danaher Corporation designs, manufactures, and markets professional, medical, industrial, and commercial products and services which have strong brand names and major market shares. Acquired 17 companies during 2010 at a total cost of $1.1 billion. 15 companies in 2009 for $704 million, and so on and so forth. Okay, have 48,200 employees, so it's a large company. It's not. That's why they're so safe on the safe end of things, because the big companies tend to be very safe companies. Talks about Rails Brothers, which I assume is some kind of a fund. I don't know exactly who they are. They own 17% of the common shares. Officers and directors own 18%. Okay. That's a good indication. We like companies where the management owns a lot of the shares of stock, because then it's in their best interest to keep that stock price high. And that keeps our stock price high too.
Unless they have options, right? And then they can play with it.
They can manipulate it around, but yeah, this is actual ownership, I think, here.
Okay.
Anyway, that's just some general information about the company. And then they go on down here for the analysis by somebody named Eric Manning, who's one of their analysts at Value Line. Says, we're looking for big things out of Danaher in 2012. As we headed to press, the company probably reported record share net for last year. The sizable purchase of Beckman Coulter has greatly enhanced DHR's earnings potential. The life sciences and diagnostic branches, blah, blah, blah. I won't read all this to you, but it tells you a little bit about it. The company itself. Now, it says down here, though, he kind of contradicts himself, because he says, we prefer these good quality shares as a longer-term bet. For the year ahead, this equity will probably only keep pace with the broader market indices. So it's not going to do anything great in the next year, but they're thinking in 2013-14, it may go on up a little farther. Okay?
Where'd you see that at?
Oh, right here. Last
Oh,
paragraph.
okay.
Yeah, right there.
It's, still for the stretch to 2014-16, the growth of the
2016,
acquisition
growth.
model should shine. So.
Yeah, right. And they pay a dividend, but it's a very small amount, so it's no big deal in making your investment decision. But that's the value line from it. Okay?
At the
Yeah.
very bottom of the right-hand side, it said the company's financial strength, and it
It's a
has
B++.
a double. So that should be something that sort of stands up as something
Could
to
be,
watch.
yeah. AAA, I think, is the highest.
Oh.
Then there's AA, then there's A, then there's B++. Mostly you're looking for companies in the B or the A areas. Anything below that is more risky. I mean, but it should pay a higher return. In other words, the market pays for risk. If we're going to invest in risky companies, we want more return on our money for that. And probably from my old days of teaching the investing class, the biggest mistake that a lot of investors make is they take on too much risk for the return they're getting. You can do better. I mean, you get down to where I can do better with bonds, for crying out loud. I might as well put it in bonds, and I'm absolutely safe and so forth. Stock's price stability is a 90, which means that basically the price holds up pretty well over time. The price growth persistence is 100. I'm not sure what that means, to tell you the truth. Earnings predictability is also a 90, which is good. Later on, if you'd want, and by later on I mean many months from now, there's another way you can evaluate stocks that I can go through that uses those four numbers and rates every stock between 0 and 100, and the higher the rating is. Manifest Investing is a website that does this it's another one of the sites that I joined some time back. And I compare notes. What I do when I look at a stock is I'll look at Manifest Investing and see what they think and say. I'll look at Value Line, I'll look at Better Investing, I'll look at my SSG, I look at Stock Central. And the odd thing is, you'll get a lot of stocks where one says, this is the greatest thing since button shoes, and one says, this thing stinks. And you think, okay, what do I do now? Do I wait these or what? I haven't quite figured that out yet. But I like to get as much information as I can prior to putting in a lot of
The only problem with doing that is it's very discouraging. I mean, it'll make you procrastinate and procrastinate.
It can,
and
yes,
procrastinate.
indeed, it can.
Because anything on the internet, I don't know if you guys have ever wanted to buy something and you go and you say, well, this versus this, and you get so many different opinions by the time you're done, you're just like...
Yeah, there's definitely information overload on the internet. So you need to kind of settle on, okay, what are the ones I have gained some trust in? For me, the stock selection guide has been consistently a good way to go. You don't hit 100%, but you increase your percentages quite a bit in the number of winners versus losers. because you're looking at, in fact, I remember reading once, they said if you do a stock selection guide on each stock you're going to buy, you've already done more research than 90% of the people out there. A lot of people will invest. I met a guy once, in fact, invested in a company. I don't even remember what it was. And I said, why did you invest in that? He said, I like the name. Okay, good luck. Hope it works, you know.
Well, I think people do that.
Yeah, they do.
To tell you the truth,
They
it
do
really
it
is.
with presidential candidates too.
Yeah.
That's a big
That's who's running the stock
big
market.
risk.
In fact, I think I sent you, didn't I send you an email regarding the psychology of investing
Yeah.
or something like that? And Crystal has that book if you want to ever borrow it from her. They may have it here in the library. But it's really interesting how it talks about people invest and why they lose money. Basically, you get a stock and it goes up a little bit, thank you, Google, and you sell it. Okay, you think, wow, I made my money, and then it keeps going up 10 more times, and you think, why did I ever sell that? Or stocks that go down. This is another failing that people have, and I'm trying to fight it in myself. A stock drops from what you paid for it, and you think, well, I'll hang on till it comes back. When it gets back, I'll sell it. It may never come back. If you got a loser, the time to dump it is now. Put your money into something that's going to win for you. You know.
Yeah, but you're talking over a little bit of time. I mean, if it does it in a week or a month, you're making two, right? Because we're in it for the long haul. So
Right.
You're saying if it drops down and then 4 or 5 months later, it's still not
Stocks tend to follow, the stock price tends to follow the earnings. If a company can increase earnings by 15% a year, your stock price will generally go up 15% a year. The market pays for earnings. So, when a company price falls, I go back to my SSG, I look at it again, get current data. If the company's still making good money, then I hang on because I know it's going to come back. Okay. On the other hand, sometimes there's a reason the price is falling because the company isn't doing as well as they used to, and the market's starting to recognize that. And the trick is, the sooner you recognize that, the quicker you can get out of it. You can bail out before everybody discovers it's a bad stock and the price starts to drop. Anyway, okay, sorry, I ramble on, so just tell me to be quiet.
That would mean that you should know when their quarterly earnings are coming out for
Yes,
each stock
and you
you
do.
have.
Yeah, you could know.
Because they're all different dates. You'll
They are,
notice too.
yeah, and you can track them in a planner. I use Value Line. I didn't bring a copy of that, but I have 3 folders on my computer under Value Line. I have one that's personal, one that is Sagebrush, forgot the name of the club for a minute, and one that's my watch list. Okay, when I record a Value Line because Value Line comes out every 3 months also. They match the earnings of the companies. When I record one, for example, well here I can show you one example. Let's see, wait just a second here. I'm sure I put it in there because Danaher was that way. Yeah, there's my Danaher Value Line. Okay, it says 12/01/20 DHR. What that tells me, that's the date of that Value Line. It was it was January 20th of 2012. That's the latest Value Line. Okay. You record it, it's an old database trick. You record the year first, then the month, then the day. 2 digits each time, so you got a 6-digit number. And that way, they'll organize themselves in date order so that you know what your oldest ones are and which ones are going out of date. So once it hits 3 months out, come April 20th, I'll say, oh, that one's ready to be renewed, and I'll go out and get my new Value Line and redo my work.
Very good idea.
Yeah. So I kind of use Value Line to track mine. And for a while here, we had a little thing for the club that I had put down that would show the dates that things came due. Because once you get one Value Line, you know the next one's coming in 3 months. And that's when the new earnings reports will come out for that company, and you'll have new data. And if you happen to hit a bad quarter, the earnings go down instead of up. 1 bad quarter is kind of a warning. 2 bad quarters is a red flag. 3 bad quarters is let's get out of this thing. There's something going on here that we don't know about. So you've got some time. It's not like you have to instantly track. In fact, one of the worst things I used to do was track my stocks every day. I had a little program that would run a ticker symbols across the bottom of my screen. All done day. I was looking at, oh, got to sell some of that. Got to buy some more of that. My wife finally said, get rid of that stupid thing off your computer. Because you can make yourself crazy.
Yeah.
I check
Best
them out.
advice you ever got.
Yeah. Once a month I'll look at prices, and every 3 months I'll look, at the whole history of the stock. But anyway, that's my methodology. Okay, so we looked at Value Line. let's take a look at, let's see, where is it? SSG, that's my own SSG. Let's look at the issue first of all. This was the Investor Advisory Service
from
issue
today.
that came out with this one, and I cut these pages out. There's a whole bunch of information. This thing is like 25 pages long.
He's bullish.
They give you 3 companies they think are good. They also give you a take on what the economy is doing right now and what areas you should be looking in. They give you evaluations of stocks that they've already advised you over the last year or so, and so on. Anyway, they gave recent price was $50.49, buy up to $61. They think it's worth up to $61. Okay, 52-week price range. Quality is above average, and these are some evaluations that they make. And as again, they've gotten various awards, and they claim, and I haven't really tracked it all, but they claim they make about 20% a year on the 80 stocks that they advise on. There's 3 accountants or somebody that do all this stuff.
And this is one of their 80, isn't it?
Yeah, this is one of their 80. And it's, Paul Smith used to get this. He was in this club many years ago, all the time.
Is this something you pay for?
You do, yeah, and it was like $300 a year, and I thought, oh my God, I'd rather put my $300 into stocks. I'm not going to buy some newsletter. But they had an offer a while back. It's been over a year now. They said, well, for $150, we'll give you a year's worth, and then you can renew at that same rate. So I picked that up. Now, technically, you're not supposed to share these, but you know, in a club, sometimes if somebody's interested, I can
I think
send
the
you
club did.
the names of the stocks. Yeah,
I think our club did.
yeah. Paul used to photocopy those things and pass them around.
In fact, I bet if you asked us all, we'd all pitch in. We'd
Yeah,
that wouldn't seem like so much.
and I can certainly send you at least the stocks, and if there's one you're interested in, I can send you the information on it or whatever, you know. Anyway, they give you lots of information about it. One of the many strengths of the Investor Advisory Service is the coverage of a wide variety of companies. They do cover a lot of different industries. They also cover stocks that are large cap, small cap, mid cap stocks, and so forth. Talks about Danaher a little bit here. Oops, I'm not making this thing work a little bit better. Okay, there we go. Yeah, Danaher divides its business into 5 segments: life sciences, diagnostics, 25% of their sales. Tells you a lot about the company itself, okay? They then, after they've given you some information about the company, and you skip down through all this, they do a stock selection guide for you, okay? Now, I never take theirs at face value. For one thing, as I looked at Danaher, and I'll show you my SSG in a while, in the early years here,
Mine's a little different.
earnings per share were climbing up, okay?
You can adjust.
And then they hit a little dip here in 2009, and then they started back up again. Well, that tells you, that translates on your SSG. Oops, sorry about that. Let me move down a little bit. That translates to historical earnings of almost 17%. Okay? What's happening is that, it's saying, it was so low here, and look how much it's come up. So it tells you it's increased 17%. But the old analogy, not the old analogy, the old advice I've gotten was that the newer information is more valuable than older information. It's like, who cares what they did 10 years ago? I'm interested in what they did in the last 5. So on mine, you'll see that I dropped out these first 5 or 6, I think the 4 years. And that dropped my earnings per share figure quite a bit. Because in the future, I'm going to depend on this, and I can't depend on them going up at 17%.
They're saying 16.7.
Anyway.
What's yours say?
11.5.
Yeah, yours is probably more realistic.
Is it? Yeah. And this was 15.3 on sales growth. Okay, and sales growth has been pretty steady, but I still cut out those years, which cuts out the early years of sales growth as well. Now they, for whatever reason, said, okay, we think it's going to be 15% on each side in the future. Okay, which is the companies we're looking for. Then the R-squared factors that you get, and I think you get this again. I have to make a comment here. You guys, for the most part, are doing your stock selection guides online with the new service. Okay. I still use the one in my computer. I have it on my hard drive, and so I don't. Yours is a little different. You have some advantages. I noticed one of the things is that you can very quickly do SSGs on competitors, and they'll draw the same lines for the competitors, and you can see where your company is compared to others. I have to go out and do a complete SSG on each of them in order to find that. That's one advantage you've got. But anyhow, so this may look a little different than what you're used to seeing. But we talked a little bit the last time. The sales, or the S's, okay, goes up, and then they draw a straight line, which basically exemplifies, if you will, it's a, what do you call it, Mike? Wait a minute, you're the
Regression line.
regression line, thank you, yeah, okay. And then the pre-tax profit, which we use, look at as well, but we're more interested in the earnings per share down here. Okay. Anyway, they figured 15%. Now, they gave you the R squared factor down here. That's your regression line, how accurate it is. If it got to 1, that's an absolute parallel. In other words, your earnings went up exactly along that line. If it's less than 1, they're a little bit off. If it's way below 1, you might have a line that zigzags up and down, and you're going to get a very low regression number. Okay, so it just gives you some idea of the accuracy, if you will, of this straight line that they've drawn through it. Now the second page, again, and the other thing I was going to share with you tonight, and I'll do it more on mine, I'm sorry, than on theirs. It gives you, basically, these are numbers that they are filled in automatically by the computer. This is all known data, no evaluation here, okay, other than the trend being up, down, or down, okay. You have 3 things here. The quality analysis has to do with, okay, we think this company is going to make 15% a year. They've done 16.7 in earnings in the past 10 years. How capable is management of continuing those figures? In other words, are they still doing a good job? Well, number 2A is your percentage of pre-tax profit on sales. Basically, that's the number of pennies out of every dollar of sales that they get to keep as profit. Okay, so in 2001, they kept 14.4 cents out of every dollar of sales as profit. In 2002, they dropped a little bit to 14.2, then up to 14.6, and so on. Okay. Generally, the trend has been up. They take the last 5-year average, they compare these numbers to it to tell you whether it's up, down, or in the middle. You may disagree. Sometimes I'll look at that and say, that isn't really up, that's more even than up. It's not that important. What is important, there are 2 things you're looking for here. You like to have a steady increase in those numbers, or at least staying even. If they're dropping, that may be a concern. Second thing is, when you compare them to your competitors, if I got another company that competes with these folks, and they're making 20% or 20 cents on every dollar, I might say, hey, I know which one I'm going to buy. They're making more money. They're getting to keep more profit than this company is. So you want to see, oops, sorry about that, I bumped the mouse. You want to see that the trend is slightly up or at least even, and then compare it to the competitors to see how well they're doing in their general market, okay? Now the second is your return on investment, and you can actually get this right off of Value Line as well. They give you those numbers on Value Line. This first one you have to calculate yourself, and the reason that it's pre-tax profit, what we used to do, I didn't bring the formula with me, but I can share that formula with you if you want. What you do is you take the profit that's shown on Value Line, you add back in the taxes that were paid, and then you divide it by sales to find out what your pre-tax profit was. The reason that you want to put taxes back in there is that we can't hold the company responsible for what Uncle Sugar does. He raises taxes, he lowers taxes, he does all kinds of crazy things, especially these last 3 years, but we won't go into that. Sorry, Rosemary. She knows I was aimed at her. Hey, listen. I think I may vote Obama this time. I don't know. It depends on what they come up with on the Republican side.
They haven't come up with that.
I'm glad to hear that, Frank.
Yeah, so I'll let you know if that happens. We'll go down to the voting booth together, arm in arm.
I took Jax with me and she canceled my vote that one time.
Did she?
Said I was sorry I introduced her to the process.
Oh, well, there you go. That's what I did. I go around and find 20 Democrats, and I agree with each one of them that neither one of us will vote. Because we'll just cancel each other. So 20 people cancel their vote. Sorry.
That's an Idaho.
Okay, I'm drifting. I apologize.
Yes, you are.
Okay. Where was I, in fact?
Drifting.
Oh, anyway, you subtract taxes out, or you put taxes back in because you can't account for what the government's going to do. So you can't hold management responsible for government decisions. The return on equity is basically how much are we making on our money, okay? 17 point, because it is our money. When we buy shares in the company, it's our money they're working with. So they made 17.7%. Then in 2003, they went down to 16.6. And again, the last 5 years are probably more pertinent than the rest. And it does indicate it down, and they definitely had a drop in 2010. In fact, 2009, they started back up from there. So they were kind of coming down, and now they're starting back up. Maybe that's going to continue upward. Maybe it's going to level out. I don't know right now. but it would be something you'd want to take a look at and just be aware of. Okay. If it was down and down, I'd probably say, hey, I'm moving on to some other stock because these guys aren't running their business the way they should. Now the third column or row that they've added more recently, which is good, that there down is good. That's their amount of debt compared to their equity, percentage of debt to equity, and so that means they're basically paying down debt. And I thought they had a jump in debt somewhere in here. They probably bought the company had to borrow a bunch of money to buy it, and that's what running their debt up. Because I mean they went on for years without any debt at all, and then suddenly they're in debt here. But still, 21% is not a big concern for me. Usually if a company is under 30%, I'm good with it. If it's over 30%, I might take a look at the rest of the industry, the companies, because some companies operate on a high level of debt and do very well. But the bad thing about debt, of course, is that in good times, everybody's paying off their debt, no problem. But when hard times hit, like the economy the last few years, those companies that have a whole lot of debt suddenly can't make the payments. So the banks don't say, hey, don't worry about it, catch us when you can. They say, we want our money, we want it now. And so a lot of them go into bankruptcy or whatever to pay that off. So anyway, those are the three areas under quality analysis that have to do with how well is management managing and can they consistently increase the earnings the way they've been doing in the past. Now the rest of these sections, 3, 4, and 5, have to do with, and I wasn't really going to go over those necessarily tonight, but we can certainly look at them briefly. The first two sections tell you whether you want to own the company or not at all. Okay? And basically we're looking for companies that make 15% a year earnings per share increase. Because that way our stock price will go up about the same and we'll double our money every 5 years. That's the target. Now, will every company make it? It's much harder for a big company like Danaher, for example, to increase their earnings by 15% because of their size. I mean, if I had a company I sold $200 last year, if I sell $300 this year, I just made a 50% jump in my earnings. Okay? If I'm a $15 billion company, it's going to be kind of hard to add $7.5 billion in sales over the next year. So we expect big companies to make slower increases. Well, we have some of those in our portfolio for the safety of a large company. I think NAIC, or actually Better Investing now, recommends 25% small companies, 25% large companies, and 50% in the middle. That gives you some safety in downtimes, gives you the small companies that cause you to jump in the good times, and the middle ones kind of get the benefit of both worlds. Okay. Now let me real quickly close this one and open mine. Let's see, SSG, there it is. Okay. Okay, this is the one that I did. Okay. Oh wait, this still says IAS, but I adjusted the figures. Yeah, it says who did the study. So I took their study, I downloaded it off of the internet, and then I went in and I adjusted the numbers. Okay. Okay. Here again, it shows you that your debt to capital. I always look up in here first. Okay, it's in the industrials area, diversified industrials, which wouldn't be bad for us to put some money into to kind of get away from the tech that we're into now. There's no preferred shares, and we won't go into that tonight, but we'll talk later about preferred shares, what they mean and what it means to us. Insiders are about 2.8% of the total holdings of the company. Institutions are 81.2%. Those are retirement funds, mutual funds, people like that.
Now that would be excessive, wouldn't it?
Well, it's pretty high, but for big companies like this, they like companies like Danaher. When you talk about investing in mutual funds, it seems like a good idea. You put your money in there and let somebody else manage it, okay? And you grow the cream of the crop with it. I see two problems with it. Number one is that they're not concerned with your tax status. So they may sell a stock at a profit on December the 28th when you've already had a high earnings that year, and you're going, oh, geez, I got to add that now because that money is passed right through to you. And so you have to pay taxes on that. So you lose control of using this for tax planning. The second problem I find with mutual funds is that mutual fund managers are averse to risk. You and I may look at a stock and say, man, that's a risky stock, but I think it's going to go. I'm going to take a chance and buy 100 shares. And we buy it, and it may take off, it may not, but we've bought it and we've taken our chances. A mutual fund manager will look at that same stock and he'll think, well, you know, if I buy that, it looks good, but if it goes down, the next morning I got 500 angry investors on my telephone wanting to know, what the hell are you doing? You know, they can't win. I mean, it's like, so they tend to stick with companies like Danaher that are very safe and solid and large. And yes, your money will go up. It just won't go up as fast as it could with a smaller company. So anyhow, a lot of them own Danaher. And that's okay. The danger in that, of course, is that if for some reason it fell out of favor with them and they all dumped their stock on the market at once, that's going to drive your price down pretty quickly. Now, if there's still company still had good earnings and was a good company, I'd hang on to it because it's going to come back. Did I tell you the story about Walt Disney? I think I did last time.
Mm-hmm.
Well, Walt Disney, some time back, not him personally, but the company, decided in Texas and other parts of the country that they would grant medical insurance to their gay couples. Okay, treat them just as if they were married. The state of Texas, which is strongly Baptist, did not like that at all, and they own thousands and thousands of shares of Disney. And they said, if you do that, we're dumping all our stock. And they said, okay. They went ahead and did it anyway. Texas sold off all the stock, and the price dropped for maybe half an hour, and then it was picked up by other people in the market. So this is a good deal. I'm going to buy the stock. And so the price went back up again. So maybe they're not as influential as we think, but
Their safety number was 2 from Value Line as well. So that's
was it? Yeah. So
Now this says that it's about the officers and directors. Would that be insiders?
yes,
This says 18%, and you've got 2.8.
yeah, and I do, and I don't know why the difference in the numbers.
what are you looking at?
The value line,
He's looking
and
at
we'd
value
already
line.
gone over that. Plus, I've kind of filled out your sheet, my homework.
Good for you. All right, Lauren.
So I did a little bit.
Okay. Yeah, and I don't know why the discrepancy in the numbers, to tell you the truth.
I mean, it doesn't look near as
This
bad
did.
when you get
Yeah.
17 above the 81,
Yeah.
but when you get 2.8 above the 81, that, according to what you're telling us, that should scare the hell out of us.
I tend to believe the 2.1, the reason being that when you got a company that's like $15 billion, I can't believe that management owns 18% of that. I mean, I'd be buying Africa or something like that.
Mhm.
That kind
Well,
of
are they supposed to equal 100%? Because
No.
they're nowhere near.
No, not just because, no, that's
Because
just...
other people
Other
earn it
people.
the
like
rest
you
of us, yeah, folks like us fill up the rest.
Yes.
Yeah, right.
That 2.8 really isn't that odd to me. I don't think because when I've done a lot of reports on it,
Yeah.
it's pretty rare to see it actually very high.
Very high for big
Unless
companies.
unless it's
Yes.
a small company just
Small
starting out.
companies.
That's right, exactly.
We'll have a lot more, right? Okay, anyway, let's see. Okay, so in the last quarter over quarter, in the last year, they've done in sales, they've increased sales by 25%, increased earnings per share by 11.6. Okay, which is not too shabby, really, for a company this size. Okay, now let's skip down here a little bit. I took out the first 4 years of this company,
I did 83.
which dropped the percentage of growth over the last 10 years.
I think you should have took out 09 too, or
Well,
wherever
you
the
could
market
have,
dropped.
yeah. However, the rule of thumb is if you take out a year and it increases that number, then you put it back in.
Oh, okay.
And when I took out that number, it increased that number down below.
Okay.
What I'm looking for is the lowest possible earnings per share I can find, because I want to be sure this. I mean, they may make 16% on their money, and if they do, I'm in hog heaven.
Mm-hmm.
But I want to make my buying decision as difficult as possible.
On the low
I think they've
On the
reported
low end.
2000. Well, you have 2011 there because your numbers are different from mine. Yours are based upon the last 5 years. 6, 7, 8, 9, 10. Oh, you did 6 years. It looks like.
6 years, yeah.
All right,
Yeah, I
okay,
just took out the
fine.
first 4.
All right.
When I took out 2006 or 2009, that dip in there,
Okay.
as an anomalous year, it increased my numbers, so I thought, okay, I'm going to put them back in. Okay. So anyway, I figure in about 8.9% in sales growth, 9.7% in earnings per share. Can anybody tell me what's wrong with those numbers?
The one on the right's higher than the one on the left.
That's right, exactly.
Should track.
Yeah. Generally, companies for a period of time can increase their earnings faster than they increase sales by cutting costs. But eventually you've cut to the bone, there's nowhere else to cut, and it's going to drop back to that number. Okay? So in the past, that's what they've done. However, in my calculation, said, okay, I'm going to figure 8.9% in earnings per share, but I'm going to drop this to 7.6%. Now, where did I get that number from? There's several places. Mostly you're just analyzing yourself. You're looking at the history, saying, what do I think they're going to do? This is what they've done the last 10 years. What are they going to do for the next 5 years? Okay. Well, one thing I do is I always compare it to what they call the preferred procedure, which it shows you right here. And again, I don't know how this does it online, but I'm sure you have a method of looking at preferred procedure. And what it does is, the theory behind preferred procedure is that sales growth is much more consistent than earnings per share. Earnings per share can be zigzagging up and down. Sales growth is fairly steady. So we just take our earnings as a percentage of sales growth and then make a line that way. And so that's what this does. It says, okay, my projected 5-year sales growth is 8.9%. I could override that if I thought some other number was more beneficial. The expenses they've had are 14.9%. They've had taxes of 25%. It gets all this information, as I said, downloaded right away. And any preferred dividends, which they don't have any, so we won't even deal with that right now. Okay. And so anyway, based on all of this, they're saying that the calculated growth rate would be 7.6, which is less than what I would have given at 8.9. But I said, okay, I'll go with a 7.6. Okay. Again, I've got pretty odd numbers here, 68.68. I understand that these R-squared factors, by the way, count the entire 10-year period, even if you've knocked out some years. So what you're looking at there is not just the last 6 years. I've calculated that would be a better number, I'm sure, than what that one is. But anyway, that's how I came up with it. Now, going back to the back page, okay, pretty much the same thing, even, down. Now this is up for debt. Now again, they only showed, what, 5 years of debt the last time? I don't know where they got their numbers from or how they're doing that. Because this is, I pulled this right off of their
That's different.
things. It's different, yeah.
There's another thing you got to figure in. Nobody's got the same number.
Yeah. That numbers are
place?
easy to.
Well, and you know, you can research that. And
Now
find
you're
out
back.
why-
You like
why
the name of the stock, so you bought it.
Yeah, exactly. Yeah, right.
Exactly.
Zeroed out their debt.
But anyhow, these should be the same here, the top 2 rows, because that again is pretty much given data. Okay, and if they don't have data for a year, they cross it out. Okay. And again, I don't know about debt, but it's showing that it's going up, which we saw anyway, because it went from 0 for 5 years, and then it started climbing again, and then it was going down after that. So
Yeah. Crazy.
anyway, okay, but this tells me that, let's see. Okay, it did hit 19, 17, 18 in the early years, but the last 5 years, you know, 13, 11, 14, 13, 14, on an average, I would call that an even rather than a down. The computer calculates it as a down, but I'd look at that and say, well, I don't believe it. I'm going to call it even. It's about the same as it's been. Okay.
What was your rating in step 4 there?
Oh, you mean down
Yeah.
below?
Mhm.
Okay. Well, the price when I did this was $51.22. It now shows me the PE ratio was 18.5. I don't know if your online one does that or not, but they've added that to this one. Shows me PE ratios. The high for the last 52 weeks was $56. So you can tell number 1 right away, we're pretty close to the high for the last year. The low is $39.34, okay? Then it gives you all this information in here, price, earnings ratios, and so forth. For the last 5 years, it gives you the high price every year, the low price every year, and then the average low price. It then gives you the earnings per share for each year. That's a 1 year's worth of earnings per share. That's not too bad. $1.86, $1.98, little dip in 2009, but everybody was having a problem in that year. Back up to $2.64 and then $2.77, okay? It gives you the price earnings ratio at the high price every year. That's basically the earnings, the high price divided by the earnings. So $44.60 divided by $1.86 is 24 for a high PE. The low PE would be the $34.60 divided by $1.86, gives you an 18.6 for the PEs, okay? Tells you the average high over the last 5 years was 21.3. Average low was 14.3. Now this is another area where you can make some decisions. And you'll find occasionally you'll get a stock that for 1 or 2 years back here maybe was hitting a high PE of 60 to 1. And you say, that's ridiculous. They'll never get that high again, okay? Tech stocks are famous for that. They get real wild years where people are buying the stock for way more than it's worth. You can click on those, and I'm sure you can do it in your online version too, and it will put a line through it and remove it from your calculations. So you're getting rid of what they call anomalies or aberrations. Any year where the prices were really high or low, or the price earnings was high or low, you can delete all that stuff, okay? Shows your dividends and what your average dividends are and everything. Now the other clue here we have is the average PE ratio has been 17.8. That means that on average in the last 5 years, people have been willing to pay $17.80 for $1 worth of earnings for this company. That's a PE is price divided by earnings, okay? Now, right now, at the current price of $51.22, the current PE ratio is 18.5. Okay. What that tells me is that stock's a little bit overpriced, because what's going to happen is PE ratios always tend to go back to average. So at some point down the road, it's going to begin dropping back to 17.8. Now, it's not too much over. Sometimes it's pretty radically out, and you say that's way overpriced, I'm not going to buy it. But the first two sections that we looked at tell us whether we wanted to own the stock or not. The rest of this is it overpriced or not? And based on this, I would say it's a little bit high, probably. Okay. But we'll look. We got more things that we look at to make that determination.
But then you also have to take into account the percent growth of earnings per share in future years as well, don't you?
Okay. The percentage of growth in earnings per share. Yes. But, again, what you're paying for is $1 worth of earnings per share. See, they paid $50 at the high end on 2011. They paid $56.10 for $2.77 worth of earnings, which means that their PE ratio was 20. They were paying $20 for $1 worth of earnings. In other words, this is nothing more than right here. The 20.3 is 56.10 divided by 277.
Right. What I'm saying is if you paid the $56.10, I'm not necessarily going to compare it to the $2.77 because for next year, I'm expecting those earnings.
What you're going to pay those next year, if earnings were $10 a share, for example, okay, and your PE was 20, let's say make it even 20 to 1, then you're going to pay $200 a share because you're paying $20 for every dollar of earnings. You got $10 worth of earnings. Times 20 would be 200. Yeah, so it'd be up to $200 a share. Yeah, so that's what we're looking at. Those the same numbers. $1. How much are people willing to pay for $1? And $1 worth of earnings. And again, the idea is that it will eventually drop back to average or go up to average if it's below average. Things tend to come back to averages. Okay, we won't, well, relative value is basically the current PE divided by the last 5-year average PE, and what you're looking for in relative value is somewhere between 80 and 110. If it's over 110, it's overpriced. If it's below 80, it's too good a deal to be true. You must have missed something. Go back and take a look at it again. So we want to get down close to 180. So this isn't really highly overvalued. It's telling 103 is still within the range, okay? PEG ratio is 2.3, which also tells you that it's probably overpriced. PEG ratio is your PE divided by your growth. And we should probably spend an evening on each one of these individually, and we can do that, certainly. I'm just kind of flipping through it right now, okay? And you got your trailing 12 months earnings per share, that's 277. We saw that right here. The projected future 12 months of earnings per share, they're saying is going to be $2.98. Where do they get that number? That's based on the growth factor that we put in the front, my 7.6% or whatever it was. It's going to grow by 7.6%. It'll grow to 298. Okay. The average trailing 12 months plus the future 12 months is 288, right between the two of those. Okay. From those figures, and I don't want to put everybody to sleep now, okay? I used to do this in class. I'd look around and the students, half of them would be dozing.
Front of his brain's on fire.
Okay, evaluating reward and risk. the selected high PE, and we're going to just take the number right from here, 21.3. Again, if there had been real high PEs in here, I would have eliminated them to lower this number. Even then, sometimes you have to put in your own figure. If it comes up and it says it's going to be, your PE is going to be 80 to 1, I'm thinking, no way. I never go higher than 30 to 1 on a PE. No matter how good the company's looked in the past, eventually they're going to drop back into the 30 to 1 range at the highest end. And I'm usually about 20 to 1 on the low end. In this case, I took the 21.3 from there. I took that times the estimated high earnings per share of $4. Where did we get that number from? Well, if we go back to the front page, my growth in earnings, fifth year out, was going to end up at $4, based on 7.6% increase per year for the next 5 years. We used to have to hand calculate all this stuff. Now the machine does it for us. Okay. So I'm taking the high PE, the average high PE, multiplying it by what I think the price is going to be in the next 5 years. It's going to be $4 a share. That says my high price for this stock is going to hit $85.20 a share.
In the next 5 years.
In the next 5 years, yeah. Okay, so there's a potential of getting to $85. You may not actually get that. Now, what's my lowest price going to be? Well, I take my average low PE, which was right here, the 14.3. I multiply that by the low earnings per share. Now, where did I get that number? Right off of here, because if in fact this is a growth company and their earnings are going to grow every year, the lowest earnings they have is what they had this last year. It's never going to be lower than that. It's going to go up from here. Actually, my stock selection guide in years 2 will probably calculate a projected 298 based on this right here. I still tend to drop back to what it is now. I say, I know it's not going to go, I don't know if it's going to get to 298 for sure, but I do know it's not going to go lower than 277 unless something disastrous happens. So that means my lowest price is going to be 39.6 per share. Now that's one way. There are 4 ways to calculate it. There's actually 5, but we'll just look at these 4 right now. You can also take the average 5-year low price, and it depends on what kind of company you're evaluating as to which one you want to use. But 98% of the time, when you're dealing with a growth company, you take 4BA, which is this one that I just calculated. But you could, for some companies, use the average low price, which was 31.3, or you may take the record low price. What was the lowest price it hit recently? And they give, that was 34.9 is the one they gave. They didn't go back into the 23.6. Or you could take the price that a dividend will support, because some people invest for the dividends, and this company has minimal dividends, so I don't know that I would use that. Anyway, out of those 4 choices, you make your choice right here. And again, I tend to go, unless I have something contrary, with the first one, 39.6. So I now know that in the next 5 years, the lowest price this stock will likely hit is 39.6. The highest is $85.20 a share. So the rest of it is pure math. The high price of $85.20 per share minus the low price gives me a range of $45.60. Now, here we get in a little different as well. The old days, excuse me, we divided that range into thirds. And we would have said that the buy range would be from the lowest price you're going to hit up 1/3. Excuse me. The maybe or hold range would be from that point up to the sell range, and then the sell range would be here to the highest price you're going to hit. Okay. Instead of using 1/3, 1/3, 1/3, I use a 25% rule, which you can set up on your SSGs too, I'm sure. What it does is it divides it. It says the buy range is the lower 25%. The hold range is the mid 50%. The sell range is the upper 25%. What that tells you or gives you is a tighter buy range. In other words, if I went 1/3, 1/3, 1/3, my buy would be probably up around $60 a share. And if I bought it at 58, I might be disappointed, okay? This way, I'm pretty sure I'm not going to be disappointed, because I'm running from 39.60 to 51. If it's below 51, I'll buy it. Now, you may recall that their advice was anything below 61 was a buy. I don't know if they're using the third. I
Talking
have
about
to.
value line or?
No, the IAS, the
Oh.
one they sent me. Yeah, they said $61 a share. Okay, and it might be. I mean, I might not buy this at $52 a share, and a year or two now it's hitting 145, and I'm saying, darn.
I like your calculation.
Yeah. Anyway, okay. Then this is my mid-range. That's 50%. That's the area where maybe I'll buy, maybe I'll sell, but probably I'm just going to hang on right now. And then up here, if it gets above $73.80 a share, it may be time to take a serious look at buying. It wouldn't be the only reason to sell. Wouldn't be the only reason to sell. There's some other factors you look at as well, but at least it tells you that the price is up there where you might want to consider unloading that sucker, or part of it. And it doesn't mean you won't buy it back later if you think the price is going to drop it anyway. Buy it back later, but it might be time to sell. Now, at the current price of $51.22, I'm just over the line into the hold range. I really, if I was interested in buying this, I'd probably buy it at $51.22. I wouldn't quibble over the 22 cents,
You could always wait a day or two and it'll drop.
yeah, that's very well. Usually it drops after I buy it. Okay, so then it calculates what it calls its upside-downside ratio. And I wish I had the actual program on this machine, because I could calculate, I can show you graphs of all this stuff. It brings up these graphs too. What the upside-downside ratio is, basically, is it's telling you the number of chances you have of losing versus number of chances you have of winning. And it bases it basically, and I don't have I guess I could draw on that board, can't I?
No, you can't draw on those. I don't
Can't
think.
draw on those? Okay, I won't do
Not
that.
on smart boards.
Oh, I could do it back there maybe, yeah. Okay, I gotta get up and stretch a little bit anyway. You still awake, Tom?
Oh, yeah.
Haven't put you to sleep yet, have I? Okay. If we take a look at, let's see, make sure these are the right markers. I'll have to tell you that story too. I came over here when this library was brand new, and I was teaching a class upstairs to a bunch of people that do salary analysis, human resource managers from around the valley, because that's what I did before I joined
Right.
staff here. Oh, no, this is good, I think, Tom. It's
Did it work?
It's not a permanent one, right?
Dry erase is what you want.
Anyway, they had these brand new whiteboards, and they had the markers there, and I thought, oh, great, so I'm drawing all over the board, showing them how to do this. And I went to erase it, and nothing erases. And I thought, oh, man, Meyerhofer's going to have my head. I just ruined this brand new whiteboard. And the janitor came in, and I said, what'd you do? He said, no problem. He whips out a bottle of hairspray or a can of hairspray, wipes it right off.
Oh,
Wow.
Yeah, so-
Are you sure it was hairspray?
Well, that's what I think. It looked like hairspray.
Usually
Yeah,
it's
he said it
alcohol.
takes it right off. It's something with the alcohol in it anyway. But anyway, it cleaned it off, so I didn't get fired or
It said
anything.
Aquanet on it.
Okay. Basically, what the upside-downside ratio is showing you, if this is our lowest price for the last year, and this is our highest price in the last year, and our current price is right here, that's telling you got this much chance that this thing may drop back down to the low price again, and only this much chance that it may climb back to the high price. So that would be one where you'd say, well, it's too risky. Okay. On the other hand, of course, if your current price is down here, you got this much chance that you might lose money, but you got this much chance you might win.
So this would be about a third of the way up then, because it has about a
Well,
quarter of the way up, right?
Yeah,
Because
it's
it would have 3 above it
2.9.
and 1 below it.
yeah.
Okay.
Basically, and that's what NAIC, or Better Investing now, recommends, that you want an upside-downside ratio of at least 3 to 1, where you have 3 chances of winning versus 1 chance of losing. So you'd be about 1/4 of the way up, and you'd have 3 chances up here, 1 chance down below. The idea is that if, let's see, I got that one here. If you buy that stock, you just have a better chance that it's going to go back up to the prices that it's hit in the past. Which is where Vistaprint is, I think, now. We're hoping that it'll bounce back up to where it was before, and we'll come out of that smelling like a rose.
So Frank, I guess the $1 million question is, if you were to say yay or nay, would you think that this would be a good buy or not a good buy at this time?
Danaher, it's iffy. It's right on the line for me. It's right at the hold zone. Let's take a look farther down and we'll see. Okay.
Kramer likes it.
Kramer? Oh boy. Let's see. Okay.
All right.
Okay. Down here, you have your total return analysis. That's the 5th section. It says, okay, if all your numbers are correct, and you've calculated this correctly, then here's what will happen if you buy this stock. Number one, your current yield is 0.2%. That's yield is the money that you're paying for the stock price divided by the dividends that you're getting each year. Okay, that's what it yields, like an interest rate in the bank. Okay, so this company is not big on dividends. We're not going to make a lot of money on dividends, nor do we want to necessarily. We're really into growth stocks. We'd rather buy the stock. In fact, I prefer companies that don't pay dividends. I want them to take that money and reinvest it in the company, buy more machinery, hire more people, and grow the company. Then the stock price will go up and I'll make my money when they sell the stock. But as we get to be more mature, is that the word, Dan? Mature. We need money to live on. I mean, Social Security just doesn't cut it all by itself, so we tend to start investing in dividend companies. Electrics are good for that. Utilities are good for paying big dividends, okay? And that way you get these coupons you get to clip every 3 months, and that supplements your income. But anyhow, this company's not big on dividends. Okay, the average yield using the forecasted high PE is about 0.2. The average PE using the average PE is 0.2. So it's about the same. Your yields are all going to be right around, very minimal. Okay. Now your compound annual total return using the forecasted high PE. Remember that we said, we thought up here, that it would hit 21.3. That would be the high PE that's going to hit in the next 5 years. Okay. So based on that, where did I lost track of where I was there for a second? Okay.
Up a little bit.
Oh, there we go. Okay, sorry. Yeah, there we go. Okay, your average high PE. Okay, average yield. Okay, compound annual total return. Okay, your annual appreciation is 10.7% plus the yield that you're getting, because those are both part of your return, equals a compound annual total return of 10.9%. So if in fact we hit that high PE that we're thinking, and the price keeps, or the earnings keep growing the way we think they are, we'd make in 5 years about 10.9% per year on this money. Okay? On the other hand, how likely are we to sell it right when the PE hits 21.8 or whatever it was? You know, the chances of hitting it right on are pretty rare. So they also give you the forecast using the average PE over the next 5 years. And that means you'd make about 7% on your money, which is probably more realistic. Okay?
So given that that's not 15%, that's probably another reason perhaps to move along to something
not buy that
else.
company, unless you need some safety. You know, if you've got all small cap companies, this is a large company. 7% growth and 7% growth in your prices wouldn't be too bad, because you have a lot of safety here. You're not taking a high risk with your money, because this company is not going out of business anytime soon. They got too much money. Okay. Now, a small cap company, a very small mom and pop store that just starts out, is going to have a very high return, because you expect that, because it's a much riskier company. They have more of a chance of going out of business. But anyway, those last 3 sections basically deal with, well, sections 3 and 4, is it overpriced, or is it a company I want to purchase? And then 5 tells you, okay, if all these factors are true, then this is basically what you're going to make in the next 5 years.
So what do the rest of you guys think about it? Any thoughts on it?
I like the management, but if you're following along the guidelines of the way we do in this, we're supposed to do. The reason he said 15% is because that's what NAIC wants you to be buying stocks that come out with.
You should average 15%,
Yeah.
because that will double your money. 14.9% actually will double your money every 5 years.
So is this a type of company that there's no way it's gonna gain over 10%?
It won't, but this gives you the safety in down markets.
And so the question would be,
You're
do
going to
we
have
need this
small
company?
companies that are going to make 25% a year, and the two are going to average out to 15%. And so that's what, when you look at investing, we're really looking at a total portfolio rather than individual stocks.
So you're
You
saying
buy stocks that will improve your portfolio, you get rid of ones that are dragging it down.
this one won't go down as fast in a a tumbling
In a down
out.
market, exactly.
Kind of a good, safe, large.
Yeah.
Long term.
Now, we've already got several large coming. We've got Google, which is gigantic. We've got CTSH, Cognizant, which is very large, and Aflac.
I guess it's a pro really would be then a different industry maybe. Then.
Yeah.
I don't know.
It's definitely interesting, and from what I hear, it does have really good management, and that is a
Yeah.
big deal.
And where did you get your source that it was good management? From the management?
Just from
or-
no. You just get on the internet and you read little. You go. I get a lot of my stuff off MSN. Just go in the invest.
Well, I don't know, maybe 20 shares,
Yeah,
$1,000.
what's the address on that? MSN?
Yeah, just MSN.com and then go into money.
You said Kramer likes him? Was he?
Yeah,
about-
Kevin's got Kramer fired.
Yeah, a
up.
lot of people use Yahoo as well. Yahoo's got a lot of good information. I just tend to stick with Google because I don't know, I've always used it.
And there's a reason why Frank brought this up, and he saw it or heard of it somewhere. And
Yeah, well,
things-
IAS brought it up. They
yeah,
said it's
yeah,
one of
and
their-
see, they bring up, and a lot of times that comes from a management standpoint of how they think the company's running and stuff.
But they will always tell you, do your own analysis.
That's because it's all your money, it's all your risk.
I think we're at a point where I would probably like to see starting to add, but if we wanted to wait a little bit more, I'm not opposed to like 20 shares of it or something. I said that'd be like $1,000. But if you guys want to wait, I don't
I'll
see
drop
it.
it back over to Kevin, and he can take a vote. That's normally how we do it, is we vote on whether we want to buy some shares or not, and how many. Somebody needs to make a proposal, though, and then somebody can second that
Well,
proposal.
that was Mike
I
making,
think you just.
Mike?
I think
Mike
Mike
made a
made
motion.
the motion.
Opposed to purchase 20 shares?
20 shares.
which would be $1,000
About
out of
$1,000,
the 32 or the $1,900 that we have.
Well, plus we got some
Excluding,
Plus-
excluding money from this evening.
Plus, yeah.
So maybe we ought to make it. Do we have to make the vote, and then if we want to up the shares, you want to do it again,
No,
or
you need to amend it now.
You need, if you want to amend it, you want more than 20
about
shares?
25 shares?
I'd second that.
Okay, 25 shares have been seconded by Mike. All in favor of buying 25 shares of, I keep forgetting the name of it,
Dana.
DHR. I'm talking symbols anymore.
I like DHR.
DHR is good.
DHR. All in favor? I'm sorry, Kevin, this
He's
is really
speaking
your
for
role.
me, thank you.
I do that a lot. Get on and shut up.
So, is that an aye from everybody?
Aye.
Okay.
Aye.
Any
Aye.
opposed?
Not gonna poll. I'm
No.
opposed.
One
Are you
opposed? Okay, we got one opposed.
Okay.
The ayes have it, this group.
Okay, the ayes do have it, so I'll make that purchase. Now, what will happen is 6 months from now, when this stock is down to $15 a share,
I'll just go.
you got bragging rights.
That's right.
I
Yeah,
told you.
That's right.
Yep.
Who was it? It was Fran.
It was always Fran. She'd come in with Yahoo or something, and we'd all make fun of her. And
Yeah,
the
she
price of
got us into Google.
yeah.
Yeah.
She got us into Google. Yeah,
About the numbers.
we didn't tell her no
Remember
when
Fran
she came
Golding?
in with
Used to
that.
work here?
Just, it's
Fran
a
Golding?
Robert.
Fran Golding, is that who
Fran
you're
Golding, yeah.
Yeah.
All
Yeah,
right.
she was in the club up until a year or so back. She pulled out.
All right. So I guess we got 25.
Okay, 25
So-
shares, so I'll make we'll make
You
a
guys
purchase
after
tomorrow.
lunch, make sure you buy those.
Pardon?
That's your job to buy that.
Yes, I know. I'll
After
do
your
that
lunch
tomorrow.
date.
As soon as the market opens in the morning, I'll put it in
All right.
order.
Okay, great. That's our first one.
Now, you know, and another thought, just a quick concept here, is the idea of limit orders versus market orders. I tend to buy everything with market orders, which means I put in the order.
And when the
If the
market
price changes a little bit, it goes in at whatever price it hits. If it's up or down, you know, you buy it. You can also use a limit order which says, I will buy the stock at less than $50 a share. Okay? If it's over 50, they won't execute the order. If it's under 50, they'll execute the order. They turn it to a market order, and then they make the purchase. Okay? I don't care for limit orders. I guess they can have some use. For example, if I had a stock that the price was $30 a share, and I think it's going to drop to 20 sometime in the next few months, I might put in a limit order at 20. And if it drops, I get the stock at 20, and if it doesn't, I don't. But our experience as a club when I was in, not Sagebrush, but Rock Creek Partners, we had a stock we really liked. We put an order in at $37 a share. That was our limit. It dropped as low as $37.50 a share. and then shot up to $75
Yeah.
a share. And we
Didn't
weren't
quite
there for
catch
the
it.
ride.
Didn't quite catch it. Yeah. Just missed it.
So I kind of resisted those limit orders, but they do have a use for it. Some people like those because
No,
it's a
they're
little
really
protection of
good
what
if
you're
you're
going to pay.
if you're a day trader. They're
Yeah,
Yeah.
right.
you put the low and the high and
Yeah. But anyway, I've rambled on long enough. Are there any questions at all?
But I was going to say that I went to the Edward Jones lecture the other day. Is anybody else there?
No.
Oh,
There
no.
was an economist over at
I remember seeing it in the paper.
at the Herod Center, and he was real interesting,
Uh-huh.
a powerful speech, and
Yeah.
he was highly recommending dividend stocks right now,
Okay.
and really poo-pooed the gold thing. As,
Yeah,
Oh,
gold.
definitely.
As a total bubble, but the audience didn't want to hear that because I had
Yeah,
a
I'll
feeling
bet.
there were
A lot of people told that.
Yeah.
and was very strong on internationals as well. So
Yeah. Unless it's in Greece, of course, then you know.
well, yeah. So, but it was interesting that he did 3 sectors: healthcare and internationals, and I can't remember the other.
So perhaps as an offshoot of that, something to think about for the future, maybe we should start to be looking more at some smaller companies that, it seems like now with this addition, particularly today, we have a lot of large companies, maybe some that would actually get more closer to that 15%
Okay.
higher, a little bit higher risk for some companies maybe.
Now, I'm going to recommend that you may want to spend $40 of your own money. This wouldn't be club money. And here's what I'm recommending. Better Investing puts on a Introduction to the Stock Selection Guide series of webinars. I attend a lot of the free webinars. I have not signed up for this one, the reason being that they teach using the online version. And it's very similar to what I do, but I figure if it's not the same, I'm not going to spend money. And I already know probably most of what they're going to share with you anyway. They have 5 different sessions. And this, by the way, I just got out of the BI site. I don't know if you've been out to Better Investing, but you're all club members now, so you have access to that site. February 13th was the first session, so we've missed that, selecting the best companies. However, they record all of these, and you can log on. Once you pay for the course, you can log in and review them anytime you want to. You just can't send in questions because the session is over. The next session is the 27th, Determining a Fair Price, Estimating Future Growth on March 12th, Estimating Future PEs, and Reviewing questions and answers, and wrap up there. Now, and that costs you $40 if you're a Better Investing member, which all of you are. If you're not, you can still join. $60, okay, for non-members. There's a place to this. I just copied this off of their website today. You can register. You can get more information on it. They have a couple, at least one free thing here that says Why Invest in Stocks, and it's about a 70-minute recording. It's a PowerPoint slideshow is what it is, and these ladies talk about why you invest in stocks and all of that, which might be worth your time.
and that's free, right?
Yeah, and they have another free one called Understanding the Jargon. What's a PE?
Selling.
What do we mean when we say EPS and so forth, okay? So you guys might want to go out and take a look. Log into betterinvesting.org. And did they send you any, I don't know how you got a username and a password.
Are you guys all,
They're all
getting
members
into
now, yeah.
iClub and looking at
Yeah.
everything? Okay.
Yeah, good.
You can actually get on there and talk to one another if you.
Yeah.
Yeah, and we'll try to make more use of that as time goes on, which I need to talk to Larry about, because Larry, I don't know if we've got you on iClub yet or not.
He's on snail mail.
He's kind of a holdout, man, yeah.
He's still using the
I just
Bacchus.
spend time on the computer to be there. I'm not.
Larry's got an
Okay.
the Bacchus. Larry's got an Bacchus he's using right now.
You'll have to meet one-on-one, and I'll guide you through the process.
You can do that.
Okay.
I can bring my laptop over, but I never use it.
But anyhow, there are other
It's a
websites.
paperweight.
Doug Gerlach has this whole site on. It's just not. It's not a webinar like this. It's basically just this is how you do an SSG and what you're looking for and the numbers, that kind of thing. And I can send you links to that if you'd like. But it's you can get more from those, I think, because you can spend more time at it than you can from me blabbing around for half an hour on a Wednesday evening once a month.
So shall we say for next time then, if anybody has any particular stocks that they are interested in or
Yeah.
have done a guide on or would like to maybe do a guide on?
Well, we were going to do Vista Print, weren't you? You're going to do
Oh, we're
Vista
gonna
Print
do that
for
one?
us.
Yeah.
Yes, you're going to bring that in for us.
You're not looking at me.
Yes.
Oh, I'm not doing that.
Jan,
Frank will help you.
I'm not ready.
Well, sure.
I thought all
we'll
you
walk-
guys
we
were
can
gonna
walk
team
through
up and
together,
do it.
Yeah.
I thought you
That
were
might
gonna
be a
team
good
up.
first one to do, actually.
Now, the other
That-
thing, and
that
I
is your
hesitate to
assignment.
mention this, but this $40 price tag, I don't know that there's no reason that you couldn't pay $40 and have 3 people sitting there going through the webinar.
Why can't you pay $40 and send out the password?
Well, I'm not the one that's going to mention that.
So who do we make our checks on?
Just Sagebrush. See you kids next month.
Yeah, we'll see you. Have a
See
good
you
one.
along.
Okay, so we're going to buy 25 shares of Banner.
Yeah.
Okay.
All right, we'll see you. $3,000?
All right, Rosemary. Love that retirement fund.
Right. I'm doing
You are
so
taking
well.
a cruise, though.
I said I haven't earned $1